Apartment fundamentals continue to underwhelm in Philadelphia, which continues to rank as the weakest major market in the Northeast region of the country. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Philly update. Back in 2010 and 2011, Philadelphia's apartment market was performing quite well. Occupancy rebounded back up to 95%, and at one point, rents were up nearly 5% year over year. But since then, the market has really leveled off. Let's start with the occupancy story, and you can see that occupancy has hovered around 95% consistently for the past 3 years now. Now, of course, that isn't a bad rate, but it is disappointing for Philly because prior to the recession, the norm here was around 96% or better. So this is one market where occupancy just hasn't been able to recover back to pre-recession levels. And that makes Philly an oddball in the Northeast region of the country where occupancy rates are very tight everywhere. And here's a list of occupancy rates among the major markets in the Northeast. Not only is Philly in last place, but it's in last by a long shot. The next worst rate is 96.4% in Hartford, Connecticut, and that's nearly 200 basis points better than Philly. And in Philly, the occupancy woes don't trace to any particular part of the market or to any particular niche. Every product age group posted occupancy below 95.5%, and only 3 of Philly's 16 submarkets reached that threshold. Those were downtown Philadelphia, Chester County, and Northeast Philadelphia. On the flip side, occupancy was weakest as usual on the New Jersey side of the metro area, rates below 94% in Gloucester County, Camden Cherry Hill, and in Lower Camden County. So with occupancy below the long-term metro norm, rents just haven't climbed much as you would expect. In fact, rent growth levels have actually eased of late. Rents climbed just 1.7% annually as of Q1, the weakest upturn in 10 quarters. So looking back, that 4.7% hike back in Q4 of 2011 was clearly a blip. And what was also disappointing in Philadelphia is that even in the segments with good occupancy rates, we just didn't see much rent growth. In fact, in downtown Philly, for instance, rents actually fell 0.7% year over year, despite that 97.1% occupancy rate, perhaps due to the recent pickup in apartment construction. This is the only submarket where apartment development has been much of a factor of late. Now, among the major markets in the Northeast region, only Providence produced less rent growth in the past year, but really rent growth levels have slowed all across the region, as you can see here. Only New York posted a hike of 3% or more, and most came in right around 2 to 2.5%. Now, a big part of the problem in Philly traces to the local economy. Job growth had been flat for quite a while. It's picked up of late, but these numbers are still very mild for a market this size, adding up to 27,000 jobs added in the past year, which amounts to growth of just 1%. And there doesn't appear to be any signs that economic growth is going to pick up much in the year ahead, so we're expecting the apartment market to produce more of the same over the next year. Look for occupancy to tick back a little bit, right around 95%, and for rents to climb about 2.5% over the next year. And that wraps us up for Philadelphia. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.